In recent weeks, the stock market has reached record highs, a trend that has sparked considerable interest and analysis, particularly in light of the latest jobs report. This report serves as a crucial indicator of economic health, influencing investor sentiment and market dynamics. As we delve into this topic, it's essential to understand how the stock market's performance is intricately linked to labor market trends. A robust jobs report typically signals economic strength, which can lead to increased consumer spending and corporate profits, thereby driving stock prices higher. Conversely, weaker job growth may raise concerns about economic slowdown, prompting shifts in investor behavior. Additionally, the implications of these labor market trends extend to interest rates, as central banks often adjust monetary policy in response to employment data. By examining these connections, we can gain valuable insights into the current market landscape and better navigate the complexities of investing in this environment. Job growth defies expectations in June. The jobs report released for June revealed the addition of 147,000 jobs, a figure that notably defied expectations, which had anticipated only 110,000 new positions. This unexpected surge in job creation is significant, as it not only surpasses forecasts, but also reflects a resilient labor market amidst various economic challenges. Analysts had been cautious, predicting a more modest increase due to factors such as inflation and rising interest rates, which typically dampen hiring. However, the stronger-than-expected job growth suggests that businesses are still willing to expand their workforce, indicating confidence in the economy's trajectory. This report carries substantial weight for market sentiment, as it can influence investor perceptions and decisions. A robust jobs report often leads to optimism, potentially driving stock prices higher, while also impacting discussions around monetary policy. As investors digest these figures, the implications for future economic conditions and interest rates will be closely monitored, making this report a pivotal moment in the current economic landscape. Wage growth slows. The recent jobs report highlighted a wage growth rate of 3.7%, which, while positive, indicates a downward trend compared to previous months. This decline raises important questions about the relationship between wage growth and inflation. Typically, rising wages can lead to increased consumer spending, which in turn can fuel inflation. However, if wage growth lags behind inflation rates, purchasing power diminishes, potentially stifling economic momentum. In the current economic climate, ideal wage growth should ideally align with or slightly exceed inflation to ensure that workers maintain their purchasing power and contribute to sustained economic growth. Analysts suggest that a wage growth rate of around 4 to 5% would be more favorable, as it would help balance the needs of workers while also supporting consumer demand. As we navigate these economic challenges, understanding the dynamics of wage growth becomes crucial for both policymakers and investors, as it directly impacts overall economic stability and market confidence. The unemployment rate drops. The recent jobs report revealed a decrease in the unemployment rate from 4.2% to 4.1%, a notable shift that underscores the ongoing recovery in the labor market. This figure is particularly significant when compared to historical data over the past 25 years, as it reflects a sustained period of low unemployment indicative of a robust economy. Such low rates are often associated with increased job opportunities and economic stability, which can bolster consumer confidence and spending. President Trump reacted positively to the report, emphasizing the importance of job creation and economic growth during his administration. His response highlights the political implications of employment figures, as they can influence public perception and voter sentiment. A declining unemployment rate not only serves as a barometer of economic health, but also plays a crucial role in shaping policy decisions. As we analyze these changes, it becomes clear that the unemployment rate remains a vital indicator of the overall economic landscape and its potential trajectory moving forward. Federal sector job losses raise red flags. In June, the federal sector experienced a net loss of 7,000 jobs, contributing to a broader trend of 66,000 federal job losses over the past 5 months. This decline raises concerns about the stability of government employment and its implications for the economy. The context of these job losses is critical, as they reflect ongoing budgetary constraints and shifts in government priorities that can affect workforce levels. Additionally, the impact of severance pay and legal delays complicates the situation further. Severance packages can create temporary financial relief for affected employees, but they also represent a significant cost to the federal budget. Legal delays in hiring or restructuring processes can prolong the uncertainty surrounding these job losses, making it challenging for the government to stabilize its workforce. As these dynamics unfold, the ramifications of federal job losses extend beyond the immediate figures, influencing economic confidence and the overall labor market landscape. Understanding this context is essential for grasping the complexities of federal employment trends. Set to breakdown winners and losers in June hiring. In June, job creation varied significantly across different sectors, with notable growth observed in state and local governments, which added a substantial number of positions. This increase reflects ongoing investments in public services and infrastructure, contributing positively to overall employment figures. However, the manufacturing sector experienced a decline, shedding jobs during the same period. This downturn raises concerns about the health of the manufacturing industry, which is often seen as a cornerstone of economic stability and growth. The loss of manufacturing jobs can have ripple effects, impacting supply chains and local economies reliant on these positions. As we analyze these trends, it's essential to manage expectations regarding the sustainability of future job growth. While certain sectors may continue to expand, challenges such as inflation, interest rate fluctuations, and global economic uncertainties could hinder consistent job creation. Therefore, a balanced perspective is necessary to understand the evolving landscape of employment across various industries and the potential implications for the broader economy. Jobs report's influence on interest rate expectations. The jobs report plays a crucial role in shaping expectations around interest rate cuts, particularly in the context of the Federal Reserve's stance on monetary policy. The Fed closely monitors labor market strength as a key indicator of economic health, influencing its decisions on interest rates. Recently, Chair Jay Powell emphasized the importance of tracking labor market data, indicating that any signs of weakness could prompt a reassessment of current policies. The latest jobs report, showcasing robust job growth, may initially suggest that the Fed could maintain or even raise rates to combat inflation. However, if wage growth remains stagnant or if unemployment trends upward, it could shift the narrative toward potential interest rate cuts. The implications of this report are significant, as they can affect borrowing costs, consumer spending, and overall economic activity. As the Fed navigates these complexities, the jobs report will remain a pivotal factor in determining the trajectory of interest rate decisions moving forward. Rate cuts in July and September. Following the release of the jobs report, the probabilities for interest rate cuts have undergone notable changes, particularly for the upcoming meetings on July 30th and September 17th. Initially, market expectations leaned toward a higher likelihood of a rate cut, but the strong jobs report has shifted these odds. Currently, the probability of a rate cut on July 30th has decreased significantly, while expectations for a potential cut on September 17th remain more uncertain, but have also been tempered. The robust job growth indicated in the report suggests a resilient labor market, which may lead the Federal Reserve to adopt a more cautious approach regarding monetary easing. However, it's essential to recognize that upcoming economic data will play a critical role in shaping future expectations. Factors such as inflation rates, wage growth, and additional labor market reports will be closely monitored, as they could influence the Fed's decisions and the overall economic outlook in the coming months. What projections are telling us? The Federal Reserve's recent economic projections indicate a potential for rate cuts in 2025, reflecting a cautious outlook on economic growth and inflation. These projections suggest that the Fed anticipates a gradual easing of monetary policy as economic conditions evolve. The significance of the upcoming meetings cannot be overstated, as they will provide critical insights into the Fed's decision-making process regarding interest rates. With each meeting, the central bank will assess the latest economic data, including labor market trends and inflation metrics, to determine the appropriate course of action. Additionally, the possibility of revisions to these projections looms large, as new data can significantly alter the economic landscape. If inflation remains stubbornly high or if economic growth falters, the Fed may adjust its timeline for rate cuts. Conversely, stronger than expected economic performance could lead to a reassessment of the need for easing. Thus, the interplay between data and projections will be pivotal in shaping the Fed's future monetary policy decisions. Why the jobs report truly matters. In this video, we emphasize the critical importance of the jobs report and its significant impact on the stock market. The report not only provides insights into job creation and wage growth, but also influences investor sentiment and expectations regarding interest rate decisions. As we analyze various sectors, the implications of job losses in the federal sector, and the evolving landscape of employment, it became clear that understanding these dynamics is essential for navigating the current economic environment. We encourage viewers to subscribe for more insights and updates on economic trends and market developments, ensuring you stay informed about the factors that shape our financial landscape. Additionally, we invite you to share your thoughts in the comments section and engage with related content. Your perspectives are valuable, and we look forward to fostering a community of informed discussions around these important topics. Thank you for watching, and we hope to see you in our next video as we continue to explore the intricacies of the economy.